Welcome back to the Millionaire Choice Show. And today on the show, we have Roger Whitney. And man, you are in for a show today. This guy is going to rock your world with where it comes to finances. He is the host of the Retirement Answer Man podcast. Go out and listen to it. And he's got his own financial planning practice. And so he's got a lot of wisdom to share with us from that. And he is the founder of the Rock Retirement Club, which we'll discuss a little bit on the show today. Roger, welcome to the Millionaire Choice Show.
I'm excited to be here, man. When I hear those things of the things that I do, I'm like, oh, I'm tired already just hearing it. So much to do.
Yeah, there's a lot of people out there mismanaging money that you need to help. You know, I think, what is it, 78% of people living paycheck to paycheck. And, you want that number to go down, but it's not going down some days. It feels like it's going up.
Well, and the hard part, too, is when you're in that situation, you feel like you're alone in that situation, and you're not. I think most situations you really are. There are a lot of other people on the same journey that you're not as alone as you think you are. And I think that's important to remember.
When you said that, what I had come to mind is like, you're not the only idiot out there doing stupid stuff with your money. That's what I was hearing, between the lines. So, and I was thinking about myself at 25 when I got that first W-2, and I realized how dumb I had been with my money. I think it was like 1995 or so. And I'm like, wow, that was pretty bad. And I'm sure change it.
I'm sure we're going to get into it. When I think of my decades, like I think of my 20s as I was an idiot. And I think of my 30s, financially speaking, spending the whole decade trying to clean up my 20s. And then finally in my 40s, I felt like I finally got my sea legs, and I was sort of mature enough to actually do it right then. So if you can jump ahead and get there quicker, the power of compounding just works in your favor. So maybe we can help.
Yeah, I think that's wonderful the way you said that. Not to park on this because I want to get to your story, but as the people listening to the show, you future millionaires listening to the show out there, you've heard me talk a lot. Like this year of COVID for me was the year I started to really try to transfer the financial principles of building wealth to my kids. And so I had a couple of teaching sessions that I had never done because no one, taught me how to manage money in my teenage years. And I didn't learn about it till I was 25. So I didn't really have anything to pattern it after. But this was the year where I actually got a few of my kids investing and started talking to them about building up their portfolios. And as a matter of fact, let's talk about this topic on the show today because it's a hot one, right? Last night, my 17-year-old son, who is a gamer, we were actually talking about GameStop and what's going on with the guys at GameStop and how these hedge funds are shorted these stocks and how these other investors didn't want that to happen. So they've helped, 1,700% gains in January?
Yeah, it's called a short squeeze, where a bunch of people come in, buy in, trying to scare out the people that had short the stock, which will make it go up even faster.
Yeah. And so how do you think that's going to end? I mean, this is kind of an interesting topic because I really haven't looked into, I haven't done a lot of that kind of stuff or looking into shorts and, options.
You know what I think about that? I think it's a total sideshow that most everybody should ignore. I mean, it has this sort of scandalous thing going on. You have bad hedge fund people. You have the white knights trying to slay the dragon of the hedge fund people. It's sexy financial news that has almost nothing to do with anybody in terms of really trying to build wealth.
That's true. I will agree with you there.
So be honest with you, I pay so little attention to any of the financial noise. And I used to not be that way. I used to really absorb it, but as I've evolved in what I do, the more I don't pay attention to what's going on in the news when it comes to markets, the better I do from an investment standpoint and from a habit standpoint.
Okay, so I'm gonna follow that thread with you, and let's explain, why do you think that is?
Why? Because I remember talking to a producer for a news show once, 24-hour news show. And they explained it to me. They didn't mean to explain it to me, but they explained it to me. They're like, look, we have 6 to 7 minute segments every 10 minutes. Then you got commercials mixed in there. So every 6 or 7 minutes, we have to come up with something new to talk about every hour of every day of every year. So they have this cycle where they have to keep throwing something up. And it always has to be structured as a tease, right? Because they do the segment. When they send somebody to commercial, they don't want them to change the channel. So they tease out the next, tantalizing fact or piece of news. So they hope they stay for the commercial to keep watching or keep listening. And that's sort of the world we live in. None of that is meant to help us. It's meant to keep our eyeballs. And I think of the internet this way as well, Tony. I think of the internet as one huge infomercial where there's everything is a lead to something else rather than actually trying to give us information. And that's hard for us to tease out the pieces of wisdom so we can actually make some progress in our life.
Yeah, I think that's a good case because I catch myself going down a few of these rabbit trails. I went down a few this week, and then I'm like, oh, I'm not going to click another link. Let me just pass that and get on to something else. But I thought you were going to go for a minute into, the words that are out there that they haven't really showed up on my show that much, but I would love for us to explore them for a minute.
Sure.
Because there's a little bit of the FOMO going out, the fear of missing out,
yeah.
or the FUD, the, fear, uncertainty, and doubt that actually causes you, like you were saying, if you pay attention to the television, it's going to cause you to make bad investing decisions if you pay too much attention.
Definitely. And so I am as enamored with those stories as anybody is. So I'm a big believer in, well, I'm not a big believer in self-discipline. I'm a big believer in lead me not into temptation. Meaning that, so what I do for myself is I have an app on my computer called Freedom that I can preset, and it won't allow me to go to Twitter or to financial news or to other things, because if I'm able to go to them, I will, and then I'll be sucked down the rabbit hole. So I actually am a big believer, just don't even tempt me. And I build systems not to be tempted to follow that type of news because I will. And then it will make me act from a decision-making standpoint. And when we think about this idea of becoming a millionaire, which I'm thinking is really just to become financially independent, that's how I think of it in my mind. The way you do that is through lots of little decisions. And the whole focus in my mind needs to be on how do I make better decisions more consistently. And if you have lots of little decisions and you can make as a total them just a little bit better, the compounding of that is incredible. So it's all about how do I make good decisions. Taking in that kind of information is definitely not one way to do it.
I love that. I'm going to transition. So I want you to, what I want to do now is I'm going to keep people on the hook because that's a great lead in. So I want to come back to that decision-making process just a little bit later in the show. And I want to go back to before you started making those decisions. What did your life look like before you started making all those little decisions that allowed you to build some wealth? So you didn't grow up with money, right? You grew up in a, kind of a challenged home.
Didn't really realize it, but when you look back on it, and I haven't really examined it much, but like my parents were divorced when I was about 2.5 or 3. We lived in Ohio. I guess we lived in Wisconsin at the time because I was born in Wisconsin. And then they got divorced and we moved back to Michigan. And my mom, we grew up as a mother, single parent. I had myself and 2 older sisters. And we initially lived with our grandparents for a while. We lived in some really crappy apartments in Saline, Michigan, and then moved to Ann Arbor. And so the majority of my childhood, we were just latchkey kids with mom trying to just pay the bills. Didn't really think about it that much. I guess I don't look backwards too much, but yeah, we didn't have much money.
Well, I can't imagine, like, I know some of the families, my sister is a single mom, and I know the financial struggles that she's facing with 2 kids. And I can't imagine what, you went through at that age until, your mother remarried and, your financial situation changed. Do you remember any of the real struggles, other than being a latchkey kid, but like some of the financial things you guys had to face?
Well, we didn't have much. I mean, we were creative in what we did, but I don't remember ever going anywhere or doing anything. I think the biggest struggle from a financial standpoint wasn't so much could we pay the bills or not. And this is just me recalling it now as an adult. It was, we were always alone. I mean, we were latchkey kids, and I don't know if it set me up for my early teens and 20s to make good financial decisions because I was alone a lot. I didn't have a lot of confidence because I didn't have a lot of parenting going on. And I think it set me up in a weird way for poor decisions early in my life from a money perspective. I think that was probably the biggest impact that I can think of.
Yeah. So what I'm hearing when you say that is you just didn't have a lot of positive role models or influences just because you were in that latchkey kid kind of situation. You didn't have the same opportunities for personal interaction with people that could have maybe a
Yeah, I
positive
didn't have a
influx
lot
in
of
your
great
life.
mentors, right? I mean, I
Yeah.
guess I had the modeling of my mom working her butt off, and I work hard, so maybe I got that from her. But I was watching cartoons and running around the neighborhood just being a ding dong, even well into my teens, actually.
Yeah, I think I did a little bit of that as well for sure. So, well, you moved out of that, and so as you mentioned earlier before we got on the show, but your mom got remarried. You guys went from being more of a low income single mom household to a middle income family. But when did you actually start picking up this idea that you could actually build some wealth and manage your money differently? What age did that happen?
I would like to say that I just remember wanting to be independent and be on my own and be able to pay for it. I never really thought about building wealth up until probably my mid 20s, but then when I thought about building wealth. So here's the timeline. I went to college, came down to Texas, and I was working negotiating leases for Radio Shack. That was my first job, working at the headquarters. And I was really bored. And I had a buddy that worked in the financial business, and he wasn't bored and he was making money. I'm like, oh, I'm going to go try that. So I spent my 90s essentially trading technology stocks because it was a great market. I had horrible money mentors. So my first money mentors were horrible because they were just stock traders full of themselves. And it was the roaring 90s. It was the new economy. It was very easy to trade stocks and make money for yourself and for clients and everything else. And those were my first real money mentors. So I learned a lot of really bad things. And we bought a house with my wife, who I've been married to forever. And then I thought I was all that. So we built a really nice house. And then, of course, I bought a BMW because that's what you do. And to this day, my wife hates BMWs because it represents who I was at that time. And then, you do these calculations. Oh, my income could only go up. So I'm just going to spend ahead of myself
Mm.
and really built a hole for myself. And so those were my first money mentors. And then it wasn't until I matured a little bit in my 30s, early 30s, where I unwound all that, got out of my big ego head, and started to really build more sound money habits. So that was a long-winded answer to your question. My first money mentors were really bad ones.
I was trading tech stocks in the 90s too, right? So about 95, 96 is when I started. So do you remember any of the trades that you made back then?
Oh, there were so many. I mean, it was all the NASDAQ stocks with huge spreads, right? LDDS Communications, you had Verifone, you had there's so many.
Yeah. I was into mostly chips, like the computer-based
Oh yeah.
technology, Micron Technologies, Intel,
MU.
Dell, Cyrix, yeah, AMD back then too. So,
I'm
and then
still really good with fractions as a result of all that. Remember, trading on the 16th and
I wasn't doing. I was more like a buy and hold. So I'd hold mine for about 6 to 9 months, and I wasn't doing day trading, so I haven't played with that. But I thought about doing it some. Yeah. So you got into that, and then so you kind of just started putting principles, and then I guess this is a good way to come back to it. I guess because you said something earlier in the show, which was, how do you stack those little decisions up that allow you to build wealth? And talk about that philosophy a little bit more.
and I think the key thing here is from a building wealth perspective is we can't compare ourselves to people way ahead of us because that can make you want to do things to jump the line a little bit. And you really have to think of it like you're building an orchard. So I'm not a farmer, but when you're building an orchard, it takes a lot of work consistently over time without a lot of harvest, right? You have to plant the plants, you got to water them, you got to fertilize them, and you have to wait for them to mature until you reap the benefits of it. And I think that's how you build wealth. You start to build habits of, obviously, number one, what you need to focus on is developing your superpower. And this is where most people mess up, because what is your superpower? You know what your superpower is, Tony?
I've got a few. I've got some. What's the other one? Some super flaws too, though. So
Yeah.
let's offset those. But if you're asking me directly, I think one of mine might be making people smile. I like to make people happy. I don't know if I can make money doing that, but I
That's a
enjoy
good
doing
power.
it.
That's a good power. So I think most people's superpower that they forget is their ability to earn an income. Right? There's this concept out there in financial called the latte factor. Right? If you forego lattes at $5 a day and you compound that $5 a day over X number of years, you can be a millionaire. Right? That may be true, but you definitely want to be prudent with controlling expenses. But that's a game of inches. The real game is, how do I enhance my superpower, which is my ability to earn an income? Because that's unlimited. And it doesn't matter whether you're starting at, I don't even know what minimum wage is right now, but starting
Well,
at
it's about to be $15,
yeah, that's right.
maybe.
So whether it's $15 an hour, wherever you're at, I think the first habit is, how do you improve your ability to earn income? Because that's the engine, right, of building wealth. And I think it's becoming intentional about that. And most people think about, well, I just need to get a better job, right? Well, there are a couple other things that you could actually take incremental action on. One is obviously skills. Make yourself, and that could be speaking skills, that could be a certification, that could be anything that enhances your attractiveness in the marketplace. And the second thing is, that we forget a lot, is nurturing your network over time and building a robust network of friends professionally and personally. And those type of things will pay off harvests later in life if you nurture them intentionally. And so it's all these little things that we have to think about if we want to build wealth.
Yeah, I totally agree with you. I think about through that is, I think one of the best investments you could ever make, and that's kind of what you're saying, is invest in yourself. Like that's going to pay more for you over your lifetime than any amount of money you're going to stick in the stock market. And it's just going to create your ability to create value and income, just like you're saying. And when I look at my life like that, I think that was one of the keys that I picked up on that principle pretty early. Obviously my parents, neither one of my parents graduated from college, but they saw the need for me to go to college, and I came out with an engineering degree. But then after 6 years, I had migrated out of engineering and into technology. And the reason I did that was because the internet was coming into age, it was becoming big. So I taught myself how to program, but that cost me $1,000 to get the software so that I could practice programming. And, that was a big chunk of my income. I think 5% of my income that year went into buying that piece of software just so I could teach myself how to program. But that carried my career now for the last 20, 30 years, 20, 25 years.
Yeah.
And,
That's a long vision, because it feels like an expense. Whereas, let's be real here in terms of wealth. Wall Street fiction is that you make money by investing in stocks. Right. And that came from the 80s, when it was 401ks, and just keep throwing money at it. In the long term, it will compound and you'll be a millionaire, which is true to some extent. But if you look historically, beyond, past, before the 1970s, historically, people used vehicles like stocks and bonds to be a preserver of wealth over time. The wealth was created through their industry, their work, their company, their job. And then they would skim off the excess wealth that they created, and put them in those kinds of things to preserve and grow them over time. And it's all got flipped upside down where now we think we can make money in stocks, is that's how we're going to build wealth. I would much rather build it through my own efforts because I can control a lot more of that.
Yeah, I love that. And it kind of brings to mind, like as I'm processing, thinking like, how do we really fix the financial system, right? And when I say fix, I mean in my world, I like to say it this way. In my world, in America, what my dream would be is that there's only two types of people: millionaires and future millionaires. And I believe that can happen. It's going to be a crazy ride to get there. But if you manage your money, and I love what you said, make little decisions that allow you to, build wealth over time or build financial independence, if that's how you want to say it. It is by making those little decisions to get there. But anybody can make those little decisions. It's not like this
Anybody.
only the rich people can make the little decisions. Anybody can make those little decisions. You just have to know which decisions to make and then make them.
Right. Right. So if we think of it, your two best investments are in your health, in yourself, and in your relationships. So if you invest in yourself, that's going to be, what we talked about skill wise, and then investing in your relationships. And the earlier you start to do that, I got a good story about that, by the way. I have a long-term friend who came from nothing in India, came here as a software programmer, and he quits his job every 5 years. And he tells everybody he's quitting. He's C-level executive now. I mean, he's, my age, in his 50s. So he's made it in that sense. But he has a beautiful example of how he invests in the network. So he calls his mother every day in India, has every single day. But he calls, and it sounds like I'm making this up when you start to do the numbers, but he calls between 3 and 5 people every single day to wish them a happy birthday. And then he emails about the same, he has 2 different lists, and then he emails other people to wish them a happy birthday almost every single day. You start to do the numbers, and he is very intentional about investing in his network. And it's not just people that might be able to help him. So he used to commute to a hotel. And so he'd always stay at the hotel Monday through Friday in DC area. The lady that was the hostess in the Marriott, during breakfast and everything else, he created a friendship with her, and he would call her on her birthday every single day. So it wasn't just looking for people to help you. He just nurtured people over time. So he has literally never had to look for a job because people know him. They love him. He's built up this relational currency over decades in some instances. And so whenever he quits and takes 2 years off to be with his family, when he puts his hand up saying, "Hey, I'm ready to get back in the workforce," he has tons of offers coming at him because he's built this network of people that know, like, and respect him and that he loves on, that are there for him. That's a perfect example of something that pays dividends personally, obviously, because he likes these people, but also professionally.
Yeah, I think, like you said, investing in relationships, I think that's the key takeaway there. I'm still kind of rocked by the fact that he cared that much.
He's systematic about it. But he's systematic about a lot of things. I mean, but and it's all from a authentic place, right? But it's an extreme example of just keeping in touch with people and seeing how they're doing.
Well, I've got 6 kids here, and so I'm like, when you think about like 3 a day, you're at what is that? 918, 180, 10,080 some odd, give or take a few birthday calls a year. And I'm going, I've got 6 kids, and I know I've forgotten my wife's birthday once or twice and missed it by a few minutes or hours. Yeah. And I'm like, I can't imagine 365.
Well, and
But like you said, systems.
you start to think of the time that it would take to talk to all these people, right? But what he does is he'll call like 5 a.m. He's an early dude. So he calls strategically to leave a voicemail that's friendly so he doesn't have to get into an hour conversation. It's pretty smart.
That's pretty. Yeah, it's pretty. He's probably worked that process up over time.
Oh yeah.
And
Oh
okay,
yeah.
well, I need to call it 5. But that's a great example, I think, of investing in yourself or investing in relationships, something that's going to pay in dividends for you. And I saw that, like, with my life, is if I've done something right. You said superpower. I am very much a growth minded individual, and so when I look back and I see something I want to learn, I just am constantly learning new things. And that's an investment in yourself, whether you're doing that through meeting people and learning what they know, or going to a conference and picking up, things from 10, 15, 20 different speakers, or reading a book or listening to a podcast. You have a wonderful podcast, The Retirement Answer Man, and just looking for all these resources. And I think today we have so much more access to resources than you did even, 5, 10, 15 years ago. So the ability to develop yourself today is exponential compared to the past.
Yeah, it totally is. And in that, and also access to individuals is easier than ever before. If you have you can have these virtual mentors that can mentor you throughout life, and you never actually have to meet them. And we've all had those. I think you had a gentleman on the show recently, Dan Miller, who's been a virtual mentor and now a personal friend of mine, is a great example of that. And you know what? The downside to that, what I think is, Tony, that you can get overwhelmed with all this information, and we can feel like we're being productive and growing, building wealth without ever actually doing anything, because we're always in preparation stage of, oh, I just got to read more. I just got to listen more, and then I'll go do something. And that's where the danger is in all this accessibility.
Yeah, I love that. I think it's a great. You mentioned something earlier when we were getting ready for the show, and I think it's a great time to talk about that. Is this model that you have for making those great little decisions, and you call it, I believe, WHAM.
Yeah. So a lot of this is doing Trump's thinking most of the time, if you're agile. So, you're a software guy, you're a programmer. So, and in our business, I've taken a lot of software development project methodology, agile project methodology, which is how they build software, and applied it to financial planning. And the key here is you want to iterate, you want to make lots of little decisions and just consistently do that, so you don't get into this what is it, analysis paralysis. And so we call it WHAM. When we work with clients, or even on the podcast when we talk about it, is the key question is always, what do I do next? Right? And that comes around, what's the number one opportunity I should focus on, or what's the number one risk I should focus on? And once you choose, okay, this is the thing I should focus on next. What do I need to focus on building my network. That's the what. Then the next thing is how. Well, how do I do that? You come up with your strategy of, okay, if I'm going to focus on building a network, as an example, how do I do that? You can use LinkedIn. You could call people on their birthday. You figure out your tactical, and then you go to the WA, what, how. The A is some assistance and accountability, right? So you have to build okay, if this is what I'm supposed to do and this is how I do it, I need help doing this. So I need some assistance and some accountability so it actually gets done. You got to put that into it. And then you just go do it. And then if you do it, you create something that is really powerful. And that's momentum. Because there's nothing better than going from what do I do to completion. And it's better to have a small, easy baby step, to use a term, a small, easy baby step that you achieve, than to have a big goal that takes forever to achieve, because that will create momentum. And then, because as soon as you complete that, you're going to get that feeling of accomplishment. And then what's the natural next question? Well, now what do I do next? And that's how you build agency. That's how you build power to start making those little decisions, is in acting in incremental fashions. It's really important.
Yeah, it's kind of like the way I characterize it, and I love your model. You're really just stacking the next best decision. You're going, okay, what do
Now
I
what?
do
What
now?
do I do next?
Stack another one, stack another one, stack another one. And if you do that long enough over time, then you end up in a really pretty incredible place. And you're allowed to make a few bad decisions along the way, but don't make any really big bad decisions. But yeah, I love that model. I think it is a great way, because it's not like, building wealth or becoming millionaires. It doesn't all depend on this one decision that you have to get right. And if you miss that one decision, you're never going to do it. It's really about those little decisions, and just keep doing that over time, and enough times it builds into something pretty incredible.
And I think so often we think of building wealth as grand gestures, right? If I just get this one big grand strategy that I read and I go do that, then it's all going to work. It doesn't work that way. We could equate this to love. You're married, Tony?
Yeah, married with 6 kids.
That's right. I heard the 6 kids, so I assumed you're married. So we can equate this to love. So the little smart decisions in a love relationship is listening to your spouse, acknowledging them when they achieve something, affirming them when they're hurting, and doing it consistently every single day, right? It is not ignoring them for the year and then buying them a Valentine's Day card with flowers and a new car. That big gesture will never make up for all those little incremental things. So just like with love, with money, it's exactly the same thing. You got to keep making these little deposits and these little steps forward in little small steps. Because if you try to do just some grand thing, well, I'm quitting my job and I'm taking every dollar I have to start this business, those grand gestures rarely work out.
Yeah, I agree with you 100%. I was sitting there as you were talking about marriage, so I'm like, hey, Roger, this isn't a marriage show, it's a money show, man. But no, it's, money and marriage are so tightly tied together. So when you talk about decisions, as we're getting ready to wrap up the show, what are some of those decisions that you've laid in place for yourself that you've made that, people could take away and say, hey, Roger did this thing, and I think that's a good decision. Roger talked about making these little decisions and stacking them up. What are some of the ones you've done?
So probably the one that most everyone struggles with is budgeting, right? Controlling their cash flow. And I have a resource that I can share with you and just give it to you and you can mail it out I hate to budget personally. I hate budgeting, and we're taught budgeting. And usually people, when they're earning money and they start to make excess money, they inflate their lifestyle to the money that they're making. That's how you don't get rich. Because the key to getting rich, just like a business, is to create free cash flow, which is money above what you expend for the overhead of your life. And the typical way you do that is just by budgeting. Well, you just need to get some budgeting software and track every single penny is how it usually goes. And I can't do it. It sets up bad conversations with spouse because they spend money on different things. So the way that we do it, so this is why one hacky thing that's a real small change in how you manage cash flow that really helped us greatly was we had all of our income come into an account other than our checking account. So I set up an account and I called it an income account. So every income that we earned came into that account. And then once a month, I journaled over the money that we could spend for that month. So let's just use round numbers. Let's say you spend 10 grand a month, just as a number, and you earn 12 grand a month. So 12 grand a month comes into your income account, which when you log into your checking account, you don't see. Then at the beginning of every month, you journal over your $10,000 and you don't care where it goes. It can go, you don't track categories, you don't do any budgeting software. And then over time, what happens? Well, in this example, every month you keep $2,000 that is outside of your vision of spending. And then that becomes 4, and then that becomes 6. That's a little structure because we tend to spend what we see. So if all of your income comes into your checking account, or if your savings can be seen by your checking account through online access, there's always something we got to spend money on. But if I don't see the money, I won't spend it. So that's one pretty simple hack to start capturing that excess cash flow so you can start investing it in whatever way that you want to.
Yeah, I love that analogy because I'm not a big believer in budgeting to the penny. I'm a believer in getting your cash flowing into the right direction. And
Exactly.
yeah, if you can get the cash moving in the right way, or the earnings or whatever you've got to get it moving towards building wealth if you want to create wealth. And you don't necessarily have to manage every penny, but you do have to at least loosely manage it some way, which I love your model there. I hadn't really thought about that. I've heard people talk about creating separate accounts. We do have mini accounts, but most of our income all flows into one account, and then we break it out to several other accounts after that. But this is the first time I've heard somebody talk about, hey, you put the money in the untouchable account and then you move it to the touchable account, if where you can spend it.
Yeah, it
um,
goes back to that idea
I like
of
that model.
don't think you just have, we beat ourselves up for not having enough self-discipline. We're broke humans. We don't. So then it's, how do you set up systems to where you don't lead yourself into temptation to spend it? Because I'm an Apple guy. I love Apple products. I'm a spender. So if I don't see it, I won't spend it. But if I see it and it's in that account, so I think we build the systems to protect ourselves from ourselves, which sets us up for those little better decisions that we were talking about.
Yeah, and I think you're making a great example. I think it's millionaire key number 9 is keep your expenses low, and you got to keep them low if you want to keep things in place. But most people, when they get that raise every year, they decide to spend it, like go buy the new car, or spend what they're making, and they're actually spending their future wealth and their ability
Exactly.
to build wealth. Yeah, that's a great point. So on top of that, that's getting your cash flow in the right place and the budget. What else you got for us, for our future millionaires that are listening?
Well, then it's to set up little systematic conversations with yourself where you decide what you do with that money. Right. So when you have a dollar, when you sit down and you look at your balance sheet, and here's the hierarchy that I go through. If I'm looking at my balance sheet, and let's say I've captured $6,000 over 3 months in this example, periodically you want to say, okay, what do I do with that money? And here's the hierarchy that I have. Number one is my emergency fund funded? And emergency funds seem like they're a waste of money, right? Because you don't earn any money on it now because interest rates are pretty much zero. It seems wasteful, but really, emergency funds are I call them the financial airbag of life. If you don't have them, your head can hit the windshield pretty quick if you have a financial problem,
And that hurts.
and that hurts. So the return is asymmetric in that when you have the emergency fund, you can protect yourself from hitting that windshield. So first, emergency fund. Second is pay off bad debt. And then third is where do you invest it? So if you get your emergency fund, you pay off the bad debt, you've given yourself enough financial margin to actually invest long term. And then, but you got to get those first two things first. And then once you're investing, it becomes another decision tree. It could be your 401k. It could be an investment is easily in, say, a certification or school or your network, or it could be in normal investments. But we just set up these systems of all these little. You follow these conversations, and we have worksheets for each conversation, which is in our book, that will help walk through. Okay, what do I do next? When I have 600, when I have more money in my checking bank account than I should, what do I do? And it walks you through the hierarchy of how to figure that out.
Yeah, just make good decisions. Now, investment. Let's use this one as a good final principle, maybe, and then we can talk about how some people can get their hands on your resources. The retirement answer man, Roger Whitney, here with us, talking to us about how to make some good financial decisions. To build some wealth and to retire. Financial independence. I think wealth means different things to different people. For some people, it's financial independence. Others say wealth. I like to say, when do you get to live life the way you want to live it? And that can mean a lot of different things to a lot of people. If you got grandkids and that's your important thing, then go do that. If you've got some other hobby or something, but what kind of stuff do you invest in? Like, is it mutual funds only, or what do you do? How do you break down your portfolio?
So I'll just tell you about my portfolio, right?
Mm-hmm.
So, we think of asset allocation in like a pie chart, right? The pie chart with all the different assets in different colors. So what I believe is you build a pie cake, right? So the first layer of the cake is your emergency fund. That's bland color. The second maybe has a little bit more ingredients, but it's, cash reserves for bigger expenses or things that you want to do. And that covers you so you feel confident for the next 1 to 5 years. And then the layer above that, unless you're a business person, and if we're just talking traditional investments, then you create a portfolio of a mix of stocks and bonds using very low cost index based funds. And then for your really, really long term money, it's 100% stocks. Now, how thick each one of those layers is depends on someone's situation. But the key thing with investing, when we're talking normal investments here, we're not talking real estate and other stuff. The key to investing is two things: time frame. What's the time frame of the money? And costs, expenses. So building a pie cake parcels out your money based on time frame. Shorter term has to be very secure because it's shorter term in nature. Longer term is more volatile, but over the long term, it sets you up for success, given markets. But the key is time frame. You parcel out based on when you think you're going to need the money and then try to control expenses.
Yeah,
Everything
and
else is a distraction.
I love the idea of the cakes, and I think that's one of the things. I think when I first started investing, I was actually doing like 50% mutual funds, 50% in stocks of my excess, right? And I was going after my debt, so it's like 50% debt, 50% investments, and then of the investment side, it was like 50% in mutual funds, 50% stocks, which looked like $1,000 a month towards debt, 500 towards mutual funds, and 500 towards stocks. So unfortunately, I was making good trades, but not with enough money to make really much of an impact. And then I went through a period of life where I just said, hey, life is simpler today. We're having kids like crazy. I wish I hadn't gone this route, but I was investing only in mutual funds and then accelerated house payments. And so we put a lot of money into paying off our house. But, that is a way to build wealth as well. Paying off your house, it's just not going to grow. It's going to grow at a different rate. And I was actually after security, like family security is what I was after. And then now that that's done, it's kind of like I've come full circle, and now I'm back into stocks, and I'm probably doing riskier type investments now than I would be back, over the last 15 or 20 years. So I'm playing with some more venture capital stuff and a little bit of crypto, which you might not advise, but I've stuck a little bit over there to play with. Um, and actually did a little bit of cryptocurrency mining in my garage, my man cave downstairs. So I didn't put too much money into it, but I had a little bit of fun. I'm a tech guy, so it was right up my alley. I had to play with it a little bit, but
Well, it depends on where you're at, right?
yeah,
Like for me,
exactly.
I have a stock portfolio, but I think of it as a sidecar to my main wealth building portfolio, right? It's if that stock portfolio goes to zero, that's fine. That's more of me in exercising some intellectual curiosity because I've done this for so long. When we get into, do we buy individual stocks and really track the markets, or do we put it into a diversified portfolio and a mutual fund or what have you? I think the key decision as you're thinking through that is where's your biggest opportunity? So if I'm going to spend X number of hours on buying or trading stocks, is that the best use of my time relative to building my engine, right? For me, my time is best spent building my business. That's where I'm going to get by far the best return on investment, even if I bought Tesla. Well, maybe not. That's where I'm going to get the best investment in my time. So I generally don't mess with individual stocks because it's going to be a distraction and my time's much better used over here. And I think you just have to come to a decision for yourself, because if you're going to go down the road of buying individual stocks and really analyzing all that, you're saying yes to that. You're saying no to other things. And it's just a matter of whether that's a reasonable trade-off. But I think that's the way to think about it. Is that a reasonable trade-off?
I agree with you because I think for different investors, you've got to invest at the level that you're at, right? And so if you don't understand the stock market, you really don't have any business like investing in individual stocks until you get some aptitude or some intellectual awareness about that. So spend a little bit of time studying it. So a mutual fund would be a safer investment for you because of lack of knowledge, lack of experience. But then I would say try to gain that experience and build, for lack of a better word, build your muscles up, your ability to do the heavy lifting. And so don't take on too much risk, but it's worth doing. But, like I think about my dad, my sister, my mom, they focus on their income and their life. And if you're going to put your attention into that, then don't invest in things you don't really understand. I think Dave Ramsey says that really well, is don't invest in things that you don't understand. And I think that is a good piece of wisdom.
Yes, I agree.
Well, Roger, how do people find you, man? You got some great information. You got some great things going on. Of course, they're going to find you on iTunes, where, 60% of podcast listeners go. And so, the Retirement Answer Man on that, but where else can they find you and get information?
Yeah, probably the best place to go is rogerwhitney.com. So that's where the show is hosted. And we have a lot of resources and worksheets on the I Hate a Budget worksheet and other resources that you can get to take these little baby steps. So rogerwhitney.com is the best place.
And leave you with one piece of wisdom. I'm going to just see if I got this right. And you correct me if I mess it up. I give you permission. It's my show, but you can fix it. You're going to get to this place of wealth or this financial independence by making a lot of good little decisions that just kind of keep stacking on each top of each other. So don't expect it to happen with one major decision. It's really just about stacking up these smaller decisions again and again and again. Did I get that right, Roger?
That is the best compound interest there is.
Wham!
Wham!
Remember that, everybody. That's wham. What do I do next? How do I do it? Assistance and accountability, and then how do you build that momentum? All those things go into building momentum. So if you do that, that's some great advice from Roger Whitney. Check out rogerwhitney.com. Check out the Retirement Answer Man, and I'm sure you'll get a lot of good knowledge. Don't just listen to my show, listen to many shows. There's a lot of people with a lot of smart things they have to say about money out there, and I want you to learn all of it. Thank you so much, Roger.
Great to be here.
The Millionaire Choice Show shares the opinions and experiences of people and should not be considered financial advice. Before making your own financial choices, please seek out a registered financial advisor or certified financial planner.